Good afternoon. Welcome to today's market review. My name is Stock Darts, and we're going to do what we do every Wednesday. We're going to take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those four, we'll take a quick look at the U.S. dollar. We'll also look at oil, gold, and silver, and then we'll move on to chart requests. Those of you that are in here, if you have a chart you want me to look at, feel free to type it into the chat, and I'll be more than happy to take a look for it for you as soon as we cover the markets. If you like what you see here, if you're watching this as a recording, you can always find more stuff from me at Twitter at StockDarts. I typically will update anything I'm going to do, whether it's a blog post or a video on there first. You can always follow these videos at YouTube at StockDarts as well, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas. Sometimes I'll just go over certain styles of trades and how they're supposed to work, and basically just any kind of extra information is usually found on there. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. Alright, so last week we were expecting the market to probably consolidate for a few days and then maybe try to rally, and that's exactly what has happened so far. Looking at the chart of the SPY, it doesn't look like we've really done much. Well, we really haven't done much if you really consider where we are now. Again, so we've got basically last week on Wednesday, we started to break down off of this really tight rising channel, and we had the shallow pullback that was basically supposed to be the most likely scenario, which is we came down, we tested the 20-pair moving average. We tried to bounce on Monday and pretty much faded the entire thing, but we've bounced yesterday and then again today. We're starting to try to climb right back up and challenge all-time highs. I think this is pretty indicative of what you're going to see during the holidays, which is a market that slowly drifts upwards. Not a lot of explosive volatility, especially when there's not a lot of news here. Now, the one weird issue that we've had here is that it's almost like we're trying to get this sell the news event where we're finally rolling out some vaccines, and the market's supposed to rally off of that, but the market kind of rallied in anticipation of that. And so every time that we've gapped up higher in the mornings trying to rally, we've kind of faded them, and then it's made up in the next day with a green candle or two green candles to try to make our way back up through that. But for the most part, the market is kind of stuck in a range. Now, we're seeing a little bit of a change in character. We are seeing new all-time highs in a couple of the indices, so what we're seeing on the S&P 500 isn't necessarily representative of what the market as a whole is doing. But as you can see, basically the market is kind of consolidating and trying to just build up enough steam to continue rallying. Now, the good thing is we did exactly what we were supposed to do when you have a rally that's starting to emerge, right? And we've gone over this now for quite a few weeks, but when you have these moving averages that are flat and they start to turn upwards and they start to spread out in distance between them, that's usually a good sign that a trend is starting to really take off. And what you want to see is the first time that you come down and test those moving averages, you want to see a bounce. Matter of fact, the first several times you test those moving averages. But obviously the first one's critical, because if you break through that, then it probably means that we're still range bound and we just had a move up to try to challenge the top of that range. And so that first test is kind of important. We were able to find support, and buyers came in, stepped up, and supported price action, and have started to push it. Now, of course, the next step is we need to actually break to new highs. But the key here is that we've kind of consolidated, and we've found some selling pressure the last two out of the last 4 or 5 days, but it hasn't been enough to really push the market downwards, and we're still kind of building upon the prior price action. We're still making our way forward, and so we're going to take out our rectangle real quick, and I want to point out what the market has done recently and why it's still bullish, what we're seeing right now. So the first thing we want to do is we want to go ahead and take a look at what we did from August to about November. And you can see that after the market rallied, we had this string of rising wedges and the market got a little overbought, and we pulled back. This was a potential topping sign, right? You can see a potential double top. We came up, we challenged the 355 area, we failed, came all the way down. We did find buyers and we stepped up, and then the next time we tried to challenge that area, we failed again and came down. So at that point, if we go ahead and just kind of go backwards and you take a look at what's happening here, we have a market that was slowing down, was already quite extended, and was coming up into pretty good resistance. And remember, in a pretty tough year where we've had a lot of issues, and at this point it looked like the market was, this is one of those turning points where the market could either turn right back down and start heading south and challenging some lower levels, or it could start to build upon what it was doing, which is what it did. And so now, if we move the rectangle tool over, take a look at the next move. So we had this consolidation range as we broke outside of the previous range, right? And now we've done it again. And so at the moment, we're kind of stair-stepping upwards, building off of that first formation, that larger formation we printed from August to November. And we had a nice one here at the end of November. And now in December, as you can see, we're stair-stepping upwards and we'll continue to move forward. And the market is not going backwards. It's actually moving forward and building towards new highs. And so, what we're doing right now is all positive. And if you're worried about the market, you really shouldn't be. What you should be doing right now is looking for new highs, and you should be looking to buy long and make sure that you're taking advantage of this as long as we continue to rally into the holidays. Excuse me. All right, so overall, things are positive, like I said, and if you look at the bigger picture, despite the fact that we didn't print new all-time highs yet, I think overall we're still in a pretty positive state here, and we're still trying to push forward. Now, the question becomes, what are the levels we want to watch, and at what point does this become a null theory or null price action? And so, I mean, I think it's pretty obvious here. I think as long as the market stays above 363, 364, then we're continuing that pattern. Now, if we falter and we fall back below that, well, then we've got something different now, right? Because all of a sudden we're below the 20, and we're below this stair step that we just kind of formed over the last couple of weeks, and we're right back into the previous range. And at that point, it becomes a question of, are we really ready to push past that range that we printed in August and November, let alone the one we printed at the very end of November. So that's the real key level right now in the short term is 364. As long as we're above that, you should be looking for aggressive trading, and you should be looking to make sure you take advantage of momentum to the upside. If we lose that, I think that puts a real dent in our expectations for rally into the holidays. Obviously, we're really just a week away from Christmas. We've got maybe 2 weeks left in as far as trading in 2020 is concerned, and we've had a rally. We've had a nice Christmas rally if you really think about it. If you go back and take a look at once we hit into November and we started getting into the holiday season with Halloween and then Thanksgiving, you could really go ahead and take a look at where we were in Halloween as we started the holiday season and what we've done since then, and you can see we've rallied very nicely. So we have had a pretty nice holiday rally, and now the question is, can we finish it off strongly, or have we seen what we expect, what we can expect to see in 2020? I think personally there's still a little bit more upside, and I think that we could still move a little bit forward. And I think the key right now is if you don't think we have more upside, well then we'll lose this 364, and if we lose that, then it looks like the rally is done. As long as we stay above it, I think there's potential for more upside. Now, if we do lose this 20, there's a pretty good chance we have to come all the way back down and test the 50, which will probably take place somewhere in the 355 area, and that would be probably the extent of downside I would expect to see in 2020, unless we have really bad news concerning the vaccine. So for instance, maybe people that take the vaccine start to get sick, or there's some sort of side effects that really weren't anticipated, and then that could really put a dent in the market. But other than that, I don't really see any news on the horizon that could really push the market through these levels at the moment. So that being the case, we should be trading off technicals, which means the moving averages should hold considering we have an emerging trend here. Now, further to the downside, which again I don't expect in 2020, we have a pretty decent support level here at 342, and then a major support level down here at 320. That's a long way to go, and yet if we fell all the way to there, it would still be a healthy market, and it would still be a market that is at the very least range bound, and still in a bull market compared to where it's been. If we go ahead and take a look at a weekly chart, and you take a look, if we came all the way back down to 320, theoretically we're still where we were as we started when we started the year, and still well above where we were last year. So despite the fact that there is room to the downside, if we did lose all that, the bigger picture, we're still in a good place because of how strong this rally has been through a pandemic and through a pretty rough year as far as a lot of people's a lot of people's lives have been with the way they've been affected throughout the year. So, generally speaking, the market has still kind of shrugged it off and has started to move forward. And at this point, is anticipating a full recovery and us getting back to where we were prior to the COVID-19 pandemic that kind of emerged at the beginning of this year. And so, overall, all things considered, this was a pretty strong year for the market. And the question now is, how do we finish it off? Now, what happens next year is still up for debate, and we'll see what happens. It's interesting. The turn of the year is kind of an arbitrary thing, but a lot of times it does have an impact on how traders view the market, and that's something we'll have to go ahead and take a look at as we get closer to January. But for now, what we're really concerned with is how we're going to go ahead and finish 2020. And my expectation is that we continue to kind of push forward and try to push to new all-time highs as we close out the year as strong as possible. And so that is what I'm looking to do, and that's how I'm trading right now, is trying to figure out areas that haven't been kind of overbought, right? And so that's the real key, and that's typically the problem you have when you have markets that are extended or have rallied for a few weeks or a month or two, is you just want to make sure that you're disciplined about your trading. You want to make sure that you are taking advantage of good trading opportunities, but you're not getting sucked into bad trading opportunities. And what ends up happening, and this is kind of basic human psychology, is people try to buy the highs and they try to sell the lows. And it's a cliche, but it's true. And so what you want to do is, when a market is at highs, you want to trade to the long side, but you want to make sure you're buying stocks that are coming out of consolidation ranges that are giving you good risk reward. You don't want to chase the stocks that are at highs that have already kind of rallied up into resistance areas. And so that's the one thing you want to be, is you want to be disciplined and make sure that you're taking the right types of trades, and you're not just getting sucked into this fear of missing out on stocks that have already rallied have already rallied without you. All right, so that's what the S&P 500 looks like. If we move on to the Nasdaq, we'll see that the Qs are starting to pick up a little bit of momentum. The tech sector has been the leader throughout 2020, but over the last couple of months, it started to lag behind a bit, and a lot of that has to do with the FANG stocks that have kind of been sluggish. Due to the fact that they rallied so strongly this year, and at a certain point, they need to take a breather, right? And people need to take profits, and you need to get new buyers to step in that are willing to take it further. And so that's what they've been going through. And we'll go over some of the FANG stocks in a minute. But if you look at the news at the Qs as an aggregate and tech, you can see that we're finally pushing out. We've printed new all-time highs today, so a little bit ahead of the S&P 500. Been up 3 or 4 days in a row. Came down, tested the 20-period moving average just like the S&P 500, and found support and moved up. Right. So everything I just said about the SPY also applies to the Qs. Really, it's a market that has been slowly building up. We had formed a nice range from August to November. Now, you'll notice again, because of the way the NASDAQ was lagging a bit, that triangle that we formed in November and early December, it wasn't actually stair-stepping above the previous range. It was actually consolidating just below highs, showing again that the NASDAQ was lagging a bit. But we got the nice breakout. And so the action we've seen in December is almost identical to what we've seen on the S&P 500. Building up to new all-time highs, came back, tested the previous breakout, and again is pushing back upwards. And in this particular case, has actually pushed to new all-time highs. So overall, again, this is positive. Also note, low volume, right? This is what tends to happen during the holidays. This is what tends to happen at the end of the year. This is not a bad thing in this particular case, because it shows that when you tend to go into the holidays, part of the reason we rally is because we don't have a lot of that high volatility or that high volume that sometimes affects some of the more negative months or some of the more impactful months. And that's part of why we kind of rise up, is because we just don't have that same sort of impact that you'll have towards the middle of the year, because a lot of the big trading desks are already kind of taking vacations and going home, and that leaves less impactful type of trades coming in. And so when you do that, you start to get that benign drift. You get these little candles. Notice back in September and October, it's not just that there was volatility as far as the overall chart. Look at the candles and look at the size of the candles, and then look at the candles we've seen from November to December. Sure, we've got one nice red candle here and one over here, but every other candle has been a pretty small green or red candle. showing that the market is just kind of drifting upwards without a lot of volatility and without a lot of volume. And while you don't normally want to see breakouts on high volume or on low volume, during the holiday season, I think it's fine because, like I said, that tends to happen, and you get this benign drift because there's not a lot of impactful selling waiting to push the market back down. Now that can change, especially at the turn of the year, or if we have bad news. But if we don't have bad news, I would expect more of this same pattern to persist, and I'd expect these moving averages to hold as we kind of drift upwards and explore new highs, waiting again for the turn of the year and to see what happens in 2021. But for now, everything looks positive, and like I said, we want to be aggressive here. Now, you still want to be disciplined, like I said a second ago. You don't want to chase price action upwards. You want to make sure that you're taking the proper kinds of trades. And so let's take a look at the FANG stocks real quick, and I'll give you a better example of what's been going on underneath the hood with the tech stocks. Right? So first thing we're going to do is take a look at Facebook. You can see Facebook, in contrast to what the market has done, even though Facebook has been slowly rallying upwards, it's not near highs. It's not at all-time highs. It's been kind of struggling. It's still below its moving averages, and the moving averages haven't really kind of done that spread out and rise that we see in a strong rally. Now, one thing you'll notice is this is the kind of stock that actually isn't a bad idea to buy right now because it's still pretty close to support. It's still in an uptrend. It's not like we're buying a stock that's in a downtrend, but it's a stock that's been kind of stuck in neutral. And really, the only problem with buying Facebook right now is that there's a lot of overhead resistance that we'd have to make sure that we kind of clear, whether it's this descending trend line or whether it's a horizontal trend line. There's some overhead resistance here, but this gives you much better risk reward than if you were just to go ahead and try to chase something that's at highs and has kind of rallied and bounced up 5 or 6 days in a row. So again, you can see tech struggling a bit. Now we are starting to see a little bit of momentum. You take a look at Apple, and Apple has actually rallied into the holidays, and is part of the reason the Qs are starting to pick up some steam. Now again, we're not at all-time highs yet, so you can see, big tech has kind of been a little bit sluggish as we've closed out the year, but it's really starting to pick up and starting to bounce. Netflix, which is one of the trades that my Patreon members took a couple of weeks ago, has slowly made its way back up and is right back towards the 520, 530 range. Again, still struggling to kind of catch up to make it to new all-time highs, but starting to pick up a little bit of steam. And the most recent one is Amazon, which is also starting to pick up a little bit of momentum and is finally starting to emerge from this triangle that it's been forming over the last 3 or 4 months. And so we're starting to see tech pick up a little bit of steam. Right now, are they at all-time highs? Is it mimicking with the market? No, they're still lagging the market a bit. But they're starting to pick up a little bit of steam and starting to make their way back up a bit. Now, part of the reason that they've been sluggish, like I said, is they were so strong throughout 2020 that they needed to take a breather, right? And we'll look at the last one. The last FANG stock is Google, of course. And we can see Google actually has been more like the regular markets in that it actually kind of printed highs and was one of the tech names that's been kind of carrying the mantle for the Qs. But in the short term, it actually has been kind of sluggish and been kind of lagging behind a bit, falling below this 20-day moving average. So, and like I said, part of the reason for this was because the tech names were so strong that they reached the point where there weren't enough new buyers, right? And this is a typical cycle when you're looking at a stock, is you need to find this rotation back and forth between new buyers and old buyers, right? So someone comes in and buys it, and as it moves up, they want to take profits, and eventually they do take profits, and you need to find new buyers that are willing to hold it and willing to consider where it is now as value. And a lot of times, in order for that to happen, you need to kind of come back down and find out where the value is and where people are willing to go ahead and take a good chunk of it and find support. And so that's what they've been doing. And in the meantime, money has rotated into some of the more volatile areas of the market, like IWM, which we'll get into in a minute. But to go back to the Qs needed to take a breather. And like I said, when that happens, you got to look for support areas where you find new buyers, and where new buyers are going to step in and replace the old buyers that bought it from before and were willing to sell at these levels. And so you find all this supply up here, which is where there's more sellers because people want to go ahead and take their profits. And then as it comes back down, you find the new buyers, and you have to have enough buyers to outnumber the sellers, of course. And this is basic demand and supply that you learn in any economics class. And so we finally have enough buyers to start to push up, but the FANG stocks, as you can see, are still kind of stuck in neutral, where they're still in the seesaw between the buyers and the sellers as they try to get to a point where there's enough buyers to kind of outnumber them. They're not quite there yet. But as far as the Qs are concerned, of course, they're still very similar to the overall markets. Like I said, starting to pick up a little bit of steam, starting to show the ability to push through. And just like the S&P 500, I think we're going to hold above 297 or so. I think we hold above the 20-day moving average, and we continue to build upwards. If we do lose that, we probably come down and test the 50, and at that point, that's probably more indicative of a range-bound market, and we're probably going to just stay stuck in this range as we close out the year. But I think that it's more likely that we try to push a little bit higher as we head into the rest of this week and into the Christmas. Now, we look at the Dow. You'll see again a very similar picture. I left a rectangle from last week showing exactly what it's doing. It's again the same exact thing as the SPY and the Qs. You have this rectangle that formed from August to November, and then you have the triangle that formed basically through the end of November and December, and then you have what we're doing now at the very end of December, right? Which is stair-stepping upwards and pushing to new all-time highs. Now, we haven't actually printed new all-time highs today, like we did across the board, but we did kind of inch up forward on Monday before we faded back to the 20-day. Now, just like the other two, the 20-day moving average has held. You'll notice again, look at the width between the 20 and the 50, or the space between them. This is usually indicative of an emerging trend. They might come back and get a little closer, but then they'll bubble right back out. And so as long as we maintain this, as long as we stay above the 20, obviously we're going to continue to rally. So that's kind of the key. And just like the S&P 500, what we want to see here is we want to see us stay above about 300 or so. If we stay above 300, there's nowhere to go but up, of course. If we lose 300, then again, that's probably a sign of a market that's tired and needs to kind of go backwards. Now, like I said, we've already had a pretty decent Christmas rally. So if we falter here, if we can push to new highs and we come down, I think that's still a good close for the year, as long as we don't give it all back. So even if we come back and we kind of stay stuck in neutral and we go back to being range bound, we come back and test the 50, I think overall it was still a pretty good close to the year, and it was still a nice rally into the holidays. But what we're hoping for is a little bit more, right? As you know, to the next week, we try to push to new all-time highs, and we continue to extend this rally that's really starting to emerge as we push our way outside of the previous range. Which again, as you can see, go back to the weekly chart, and you can see we've had a very strong rally, and even though it looks like it's gone straight up here, there have been pretty nice ranges where we spent some time sideways. Again, getting that exchange where we get rid of some of the old buyers and get new buyers that are willing to step in. In this case, in the Dow, around the 265 area, we found buyers that came in and bought it in September. And then we found more buyers that bought it in October, and those are the ones that have been kind of pushing it upwards and propelling us through to new all-time highs. And so it's that same sort of price action. And what we have now, again, is a market that's right just at the cusp of all-time highs. And the good thing is, as we'll see in a second with IWM, all four of the major indices are right at all-time highs together, which is something that we haven't seen very often and is usually indicative of a strong trend. And if that's the case, then we can hope for a further rally as we go ahead and try to close out 2020. Now, the key levels here, again, like I said, 300 is the important level. Below that, probably somewhere in the 290 range and somewhere around the 50. And I don't think we go anywhere below that unless we get a lot of bad news coming into the end of the year. So I don't expect 280 to be in the cards, and certainly not 265. But those are the next two key levels in case for whatever reason there is a lot of really negative price action that kind of emerges. But that's not, at the moment, that shouldn't be an issue. Like I said, everything has been pretty benign. There hasn't been a lot of volume and there hasn't been a lot of volatility. And so I wouldn't expect us to really go backwards too strongly as we close out the year during a time when it's typically a little bit more relaxed and a little bit less dangerous as far as trying to trade. So overall, things are looking pretty good. Now, the last index we want to look at is IWM. And as you can see, the small caps continue to actually behave pretty strongly and continue to be the leaders. And we looked at that last week and we pointed out, as long as this kind of continued, we can expect the market to continue rallying. As you can see, we're getting a little bit overbought here. We're getting a little bit stretched out, and that's the one real issue right now, is that despite the other indices kind of grinding sideways, IWM has steadily climbed. And considering IWM is the leader, once IWM takes a breath and starts to consolidate, it's a pretty good chance the other three will kind of follow suit and continue to trade sideways or head back down. So the one real issue I have as far as looking for rally on IWM is that it's been rallying. And so at a certain point, it's going to have to take a breather. And the best we could hope for, as far as the most ideal scenario, would be that money rotates back into tech as IWM takes a breather. So at a certain point, the small caps are going to have to come back and test this 20-day moving average. And when they do so, will money rotate back into stuff like Amazon and Apple and Facebook and kind of keep the markets going upwards even when some of these small caps take a breather? And I think that would be the best case scenario. But more likely, really what's going to happen is when IWM takes a breather and comes back and tests the moving averages and loses this kind of steep trend line, that the other indices will kind of follow suit and kind of pull back a bit as well. And so that's like, again, I don't expect a major pullback at this point, but, the market's starting to get a little bit tired. And that's why I mentioned before that you want to be disciplined. You don't want to buy the charts that are doing this. You want to buy the charts that were doing some of the stuff we saw in the tech sector, where they're kind of coming off of ranges of consolidation and starting to make their way upwards, rather than the ones that have already gone up for 7 out of the last 9 days or 10 out of the last 12, because it's just normal price action is going to mean that at a certain point it has to pull back, and it's not going to mean that it's a stock that's it's a bad chart or a chart that has to go down too far, but you need to get that rotation back and forth, and so that's kind of the one real issue. But I think this, more than anything, just illustrates just how strong the trend has been in the holidays, right? So again, if you go back and you take a look at where we were as we hit October 31st and we hit Halloween, right? What did we do since then in the holiday season? We've just gone straight up. And like I said, we still got another couple of weeks to go as we head into Christmas and into New Year's. So, overall, this is good, and we should be aggressive here. We should be buying, but we should be buying stocks, like I said, that give us good risk reward. Now, key levels here. I think with a stock that's this strong, the most important thing is the 20-day moving average. And then beyond that, we have a couple of short-term levels. This 187 is kind of a level, but it's probably going to be more correlated to what happens at the 20. And then below that, we have this next level of price action here in the 178 to about 183 level. I don't think we fall below that this year. Like I said, I don't think we actually dip below anything in this area into the close of 2020. And so I think that even if we do pull back, I think it's still a buying opportunity as long as we're a little cognizant of what's going to happen at the turn of the year. Now, we'll discuss this next week. Let's see, next week, Wednesday is the 23rd. We'll probably have a Wednesday webinar or Wednesday stream next Wednesday. I'm not sure. It depends on where I am as far as doing the holidays are concerned. But we'll take a look either on the 23rd or on the 30th at what we can expect at the turn of the year, right? Because a lot of times, as you head into a new year, even though in reality the market environment should be the same, there's sometimes a bit of a change in market character as you head into January. And we'll go ahead and try to figure out what we want to do as far as that's concerned. But for now, as we head into the next couple of weeks, if we do get a dip, we come back and test the 20, that's probably going to still be a good buying opportunity. And we still want to go ahead and try to take advantage of this this momentum and this bias that's to the upside. Again, sellers have had very little impact on the market. And when sellers can't really impact the market, that's a good time for us to take advantage. So, if you head back to August, September, I was pointing out this was not an easy time to trade, and it was a time where we need to be more cautious and a little bit more picky about how we were trading. Right now, we're in a market, and as I've been kind of harping on this for 3-4 weeks now, we're in a market that is very beneficial to us and is going to erase a lot of potentially bad trades just by the virtue of how strong it's been. And so we want to go ahead and take advantage of this, and we want to go make sure that we're taking advantage of this upward momentum when it's there. Because the market isn't always going to behave like this, and we're not going to always have conditions that are this easy to trade. So for the moment, things are good, and we want to take advantage of it as much as possible. We just want to make sure that we don't chase anything, right? That you're finding the right stocks, and there are plenty of stocks out there. You just have to go ahead and actually look for them. So that's the four major market ETFs. You guys have any chart requests? Feel free to put it in. I'm going to take a quick look at the U.S. dollar. We're going to look at oil, gold, and silver, and then, like I said, we'll take a look at any charts you guys have and see how things are shaking out. But as I said, overall with the markets, we're in a bull market. We're at all-time highs. The market is rallying. There's nothing to be nervous about. There's nothing to really keep us from trading to the long side other than making sure we're not chasing stuff. All right, here's the UUP index, and quite the opposite of the market. And a matter of fact, because they're kind of inversely correlated, this is part of the reason why the market is doing so well. And the U.S. dollar continues to kind of go down, even though it's interesting and kind of sad. We've got 1, 2, 3, 4, 5, 6, 7, 8 green candles out of 10, and yet the dollar is just going straight down. So the one thing you could say is that it's closing strong every day, right? So it's trying to bottom out, but it hasn't bottomed out yet. And it's actually still kind of struggling, and it's still kind of going down. And you can see the moving averages. It's quite the opposite, again, of what we have in the market, where you have them curling downwards and spreading out, which is indicative of a downwards trend rather than an upwards trend. So the U.S. dollar is not doing well. And now, again, this actually bodes well for other commodities and for other and equities, right? So it's good for the stock market. It should be good for gold and silver. It should be good for Bitcoin, and it should be good for oil, because all of that is priced in dollars, right? And that's what we're kind of seeing across the board. So let's take a quick look at some of these currency crosses, and then we'll take a look at gold, silver, and oil, and even Bitcoin. So the euro, again, remember this chart is the euro chart, so up is good for the euro, and down is good for the dollar, right? So as you can see, the dollar is breaking down as the euro breaks out. Now we have a little bit of a shooting star today, so maybe the euro is finally finding some resistance, and the dollar is finally going to find a little bit of strength here. But for the moment, again, this is a bullish chart showing that the euro is increasing in strength versus the dollar. Now, if we look at the U.S. Canadian, we're going to see a similar picture. Now, this is a U.S. dollar chart, so it's going to be just the same as the UUP, where down is bad for the dollar. And as you can see, the dollar is just going down. It just keeps going down and down and down, and really struggling. And this, again, this chart is very inversely correlated to oil, so we're going to see in a second that oil has actually done well in the face of this. But the U.S. dollar is struggling versus the Canadian, and the one chart that the U.S. dollar was holding up against, it actually is starting to lose ground also, is the yen. So the U.S. dollar is even losing ground versus the yen. Now, again, the one thing I could say about this is two of these three charts showed the dollar maybe trying to bounce in the next few days, but even then, the bounces are going to be below key levels of support and in the middle of, or the midst of, a downtrend. So overall, this is not a good look for the U.S. dollar, and it's part of the reason why we're seeing other parts of the seeing the market, and we're seeing gold and silver start to bounce a bit. Now, gold and silver are still not quite where they need to be. I'm going to go to silver first, because silver's been a little bit more productive. It actually got above a pretty important level here around 2280. And was able to get above its moving averages, so it has made a little bit of ground. But when you look at what the U.S. dollar has done, and you look at what silver has done in the short term, it's not that impressive. And if we look at gold, it also is not that impressive. It actually is still struggling below some pretty key areas that are supposed to be good support zones. And you can see the moving averages are still kind of struggling. Now, we went over this last week, and like I said, I'm still not 100% sure what's going on here and why they haven't bounced more strongly, considering the weakness in the U.S. dollar. The long-term picture is still fine. Right? You take a look at the long-term picture, and gold is still in a pretty good uptrend. It's just really struggling in the shorter and the intermediate term. And I don't really know why this is. I don't know if it has more to do with Bitcoin, or if it's just something strictly with gold and silver. But they haven't done as well as I would have expected, considering the weakness in the U.S. dollar. If you look at Bitcoin, you can see it has done very well, and it's starting to explode and really gaining a lot of momentum here. And if you go ahead and you take a look at a longer term chart, you can see what it's done. and we're reaching a point where we've just eclipsed the 2017, 2018 prices, which was back when it was in a real frenzy. And so, we're seeing some really impressive price action out of Bitcoin and to a certain extent out of more cryptocurrencies as well. Uh, and this could be just the beginning of another big move coming in this area. So I think this is part of what's going on with gold and silver, but I don't think it's the whole picture. But again, I'm not really much of a fundamentals guy, so there's probably other people that know more of why gold is struggling a bit. But like I said, long term it's fine, but in the short term it's just not quite where it needs to be. But it is showing a little bit of change in character, and it is starting to make its way back upwards. My problem with this is when the dollar bounces, which it will at some point soon, will gold and silver get hammered, or will they just kind of ignore it like they've been ignoring the weakness? And I think that's kind of the key. Now, oil, on the other hand, actually has been kind of trending upwards. And as you can see, it's really starting to make its way. Now, it's been doing it a little bit of slow motion move, right? Because if you take a look at what it's done over the last month, it's gone from 44 to 47, so it's only rallied about $3. But the important thing is, it stayed outside of this range that it spent a good portion of 2020 in. You come all the way back here, all the way to May, and it's been kind of trading between 35 and about 43, 44. And it's finally kind of leaving that area behind, and it's making its way up now. It's probably getting close to a short-term ceiling, and we'll have to come back down. But I think at this point we can assume that any move back down to the 43, 44 range should be support, and it should now be the beginning of the new range that it's going to develop, and the floor should be around 43, 44. And the ceiling, we haven't quite found the ceiling yet, but it's probably going to be somewhere below, right around or below 50. I don't know that our economy is ready to really sustain oil prices above that. And until it does, it probably is going to range somewhere in that $4 or $5 range, between about 45 and about 50 or so. Oil names have been pretty decent trading ideas over the last few months. Gold and silver names, like I said, I feel like haven't been. So if you're looking at commodities, I think oil is probably a better area than gold and silver at the moment, or the miners. However, you're probably better off looking at cryptocurrencies if you have that capability. If not, you're probably still better off with regular stocks, and trying to play that bounce back and forth between the small caps and the tech names, which is part of our focus this year. Is really just kind of going between those two kind of big categories of stocks, which is the ones that benefit from COVID-19 restrictions and the ones that have been hurt by them. And at the moment, the ones that are doing well are the small caps and the stocks that have been hurt by COVID, which are starting to recover, because again, we've got a vaccine in place now, and the expectation is that we'll be opening up the economy more and more as we head into the next year. All right, so oil, gold, silver, commodities, that's all of it. If anyone has a chart they want me to look at, now's the time to type it in. Let me know. Fat Boys, if you're in here, if you want to take another look at Sandridge, I think you asked me about that earlier this week. We could take a look at that. If anyone else has something they want me to look at, feel free to type it in, and let's take a look at what you guys are looking at. I don't have much that I want to discuss as far as charts this week. A lot of the stuff that we've had has done well, but we've kind of already covered it the last couple of weeks. Also, it doesn't have to be a chart request. You guys have a chart request per se. If you guys just have a question regarding any of this that I just went over, whether it's the chart patterns, whether it's the way I look at these technicals, you can feel free to ask any question along those lines. Or if you want to go back and ask me another question about the overall markets, feel free to ask. I'm here to interact with you guys, and so it's talking for 30, 45 minutes without any kind of interaction. Sometimes there's not much left for me to talk about. So if you guys have anything else, feel free to put it in. All right, so Fat Boys, it's kind of funny. I just pointed out gold and silver. Let's see. You want to look at this one, Pan American. All right, so I don't know. Like I said, I don't know that gold and silver are really at a spot that I'm not excited about. The chart itself, this is not a bad chart. It's doing kind of what we're seeing with gold and silver, right? Which is in the long term. In the long term, it's a very nice chart, and in the intermediate term, it's correcting. Now, I think if we look at the bigger picture, it's not a bad stock, and it's not in a bad place, right? We've got support here, right around the just below 30, right around 29, 28, right? Um, and if we go ahead and take a look at what it's doing, it's basically just in a channel, right? Now, there have been a couple of moves inside and outside of the channel, but if you look at it along these lines, PAAS is not in a bad place, right? So long term, it was a decent buying opportunity over the last couple of days or weeks, but it's not necessarily outside of this channel yet. So now that we see kind of in the long term what's happening here, it's not. It's just like gold and silver, where I feel like it's making progress and it's bottoming out and getting ready for the next move. You had that really strong move, and then, like I said, what happens a lot of times is what we discuss with the markets is eventually all these buyers, they're going to take profits, and you need new buyers to come in, and you need new buyers that are willing to go ahead and hold it for longer moves. And the way you do that is they have to come in and find what they consider to be value, what they consider to be good support areas. And there was a good support area here around 31 to 32. You can see there was a lot of buying in this area, but ultimately it wasn't enough to overcome all the selling pressure that came in as this broke out into the mid-30s, right? There was just too much selling pressure, and so it came back down, and it's in the process of testing the next area where buyers are going to consider this as value. So we come back down here, and so what we have now is we have buyers that stepped in this area, but they're underwater. So what they need is they need to have more confidence in the next support zone, and they need new buyers to come in and kind of stick and support with them. So that's the next level. Now, if this doesn't hold, well, then we're going to have to come all the way down to 25, right, and come down to this area. And that'll be the next area that you need to consider. So, Pan American's not out of the woods yet, but I think it's in the process of forming a bottom. And there's a good chance that we've kind of hit where we need to in order to get enough buyers. But now the buyers have to kind of overwhelm the sellers. And for that to happen, we're going to need to see this channel broken. So that's kind of the next step. And that's where we're going to move to the more short-term chart now and look at the daily. So now we see, the smaller picture, where we stand. And so the issue I have right now, as far as trading this, is there's not a good trade setup right now, right? So for someone that was really aggressive, they could have tried to buy here, or they could have tried to buy here, but even those weren't very clean patterns. And so the problem is, if you're buying while it's still inside this channel, you're getting a messy trade because there's a lot of choppy price action. And so this always happens when you have a channel like this. When you have these conflicting trends, you have the long-term trend up, the short-term trend down, you have a lot of buyers and sellers that are in conflict, and so you get a lot of choppy price action, right? And that's what we're getting. We're chopping back and forth. Now, the problem I have with a stock like this is once it's clear and free of this, the risk reward's not as great as it is when it's in the midst of this kind of choppy price action. So you kind of have a situation where you're going to have to kind of give leeway one way or the other. Either you're going to have worse risk reward and wait for it to emerge outside of this channel, or you're going to have to deal with the fact that it's lower probability and good risk reward if you buy it when it's down here in the 29 to 30 range. Now, right now, you don't have either, right? Because you don't have good risk reward because it's in the middle of the channel. You have just as much upside as you do downside. Now, if you didn't have these trend lines here, you'd say, well, my upside's all the way up to 39, and my downside is here at 28, right? So you've got 2 or 3 points of downside and about 8 points of upside, right? And that's pretty good risk reward. However, that's the kind of trade that's going to take months to materialize. If you're looking for a shorter term trend, or shorter term trade where you're just looking to kind of catch the legs as it moves in and out of these ranges, well, it's going to have a lot of overhead resistance here as it comes to the top of this channel, and again, good support down here. So what we would ideally want to see, as far as getting a good risk reward move, is we'd want to see it come down to here, and then we want to see it come back down again, and then finally we'd want to see the breakout somewhere down here where we get better risk reward, right? And then that way we have, again, 2 points of downside, and we have maybe 6 points, 7 points of upside, and that would be probably better. And maybe even you could even manufacture it down to a point of downside if you just want to use the whatever price action develops here. So for instance, maybe it comes like this, right? And then at that point you could use this as a stopping point instead of all the way down here. So this is the kind of stock that I would put on my watch list. I think gold and silver are starting to do better, but I don't know that they've done enough to convince me that I want to trade them compared to other areas of the market that are giving us a little bit cleaner moves. But what I'd like to see again is I'd like to see it emerge from some of this more muddy water and into a little bit of a cleaner spot where we can get a cleaner trade without having to kind of sit out and watch it chop back and forth. Because see, here's the problem sometimes, and I've kind of discussed this before. For any of you maybe in here that isn't a regular, when you're trading, your number one concern is protecting your capital, right? You want to make sure that you're controlling your risk, because really that's the only thing you can't control. You can't really control what a stock does. There's a certain amount of randomness to any trade that you take. You have to kind of deal with probabilities, and so you could take a great trade and do everything right and still lose money, right? The only thing you can really do is control your risk prior to taking the trade. So tell yourself where you're going to stop out, how much you're willing to risk, and what you're looking for as far as a reward is concerned. So number one concern is protecting capital, right? But there's another thing you want to protect, and that's your mental capital, your psyche. Because traders, trading is a very emotionally taxing thing to do. And what ends up happening is sometimes traders take trades that look good at the time, but they don't understand the toll it's going to take on them mentally as they deal with the trade once it starts to take place. And so you take a look at something like Pan American Silver, and even if you got a nice entry, let's say right here at 29.35, right? So we had a false breakdown below 29, and then it came up and it broke out, and you had a nice entry that you considered to be really good at support. And then it bounces, and you feel really good about your trade, and then it comes all the way back down, and now you feel really bad about your trade, and you don't know whether you should stop out. And what happens to a lot of traders is they'll stop out here and take a loss, and then it'll bounce over the next 2 days, and then they panic and they buy it again. Then it's going to come up here, and it's going to get another red candle. They're going to panic and they're going to stop out. Then it'll bounce again. And so what will end up happening is they might have been right about the trade, but because they bought in the middle of a range where there's a lot of choppiness and a lot of back and forth, mentally they made, and I don't even want to say it's a mistake. It's not a mistake to stop out here, but mentally they put themselves in a position where they had to make decisions that maybe they didn't want to make. And so you put yourself in a hole where you start to trade more poorly because you're exposing yourself to decisions that are not easy to make once a trade is in place and once it's going back and forth. So what you want to do is make sure that you are taking trades when the skies are more clear, right? And when you have less potential choppiness and less potential pushback on your trades. And so that's when you want to go ahead and kind of go in the other direction. So I know that's a long way to analyze this, but basically what I'm saying is I like the chart long term, but I think in the short term it's not in a spot right now where we have an easy trade to take. Okay? Alright, if anyone else has another chart, let me know. If not, we can probably wrap it up here. Like I said, there's not a lot as far as what I've been looking at that I want to go ahead and cover right now. So it's really this is about it. Alright, well that looks like it. Fat Boys, I hope that helps. Like I said, I like the chart. I just don't know that I'm ready to trade it right now. But maybe in the next couple of weeks, if you want, bring it up again next Wednesday, and we can look at it again and see if silver and gold pick up a little bit of steam. If not, I hope you guys have a good rest of this week. We should still be meeting next Wednesday, but if for whatever reason my holiday schedule gets a little busy and I can't, hope you guys have a good Christmas. And again, things might be a little bit more erratic here as we head into the holidays, but we should still meet at least a couple more times before the year's over. Other than that, again, I'll see you guys next week. And if anyone else has questions and you didn't want to ask on here, you can always ask me on Twitter. Okay? All right, guys. Have a good rest of the week.